Okay, it's after 10 o'clock and we are the Financial Committee meeting the second time. It gets better. And we have the committee members in attendance, except for Jack Flesher at the moment, who was going to call in. But we do have a quorum. And we do have surprise guests from Fulton and the treasurer from City Council, Ellen Lorraine. So any revisions or deletions to the agenda? Agenda.
Ellen Lorraine's the assistant city manager. That's a title and financial person.
Okay, then the first item, which is number 4 on the list here, is a presentation from Fulton Bank on line of credit options. And we will turn the floor and the presentation over to Fulton Group.
So I'll begin. Hello, I'm Sharon Pearson. I'm your local relationship manager with Fulton right here in Lewes. Thank you very much for having us this morning. We appreciate you taking the time to let us come in and talk a little bit more details about our services at Fulton and how we can better help the Board of Public Works achieve your goals. So I'm not sure if you're aware, but Fulton and the board have had a long-term relationship over 16 years, a banking relationship. We appreciate your business. We thank you for that long-term partnership. I've had the pleasure of working with Austin, Kim, and Christina over the past year. We've been enhancing that relationship, bringing some value-added services and benefits to yourself. So we've had some discussions, kind of how we got here. We've had some discussions with my team and yours regarding your line of credit, your working capital needs, cash management, treasury management services, retirement services, employee benefits, as well as your investment management portfolio. So as you can see, Fulton comes with a team. We bring the team approach. We put our clients' needs first and customer services a priority. So I have brought over 150 years of banking and or investment management experience with me today. So that is a nice way to not ask them how old they are. So having said that, we would like to share our experience and our expertise with you today with regards to your investment management portfolio and lines of credit. So having said that, I'd like to introduce our first guest and my partner, Mike Wiggins. He is Vice President of Nonprofit Services. He deals strictly with nonprofit organizations and municipalities in our local footprint. Mike, the floor is yours.
Sure. If you could go to slide 3, that would be great. So just a little background on us. Fulton was founded in 1882 and is today a $28 billion financial services company traded on NASDAQ under FULT. We have 200 offices and 3,200 employees in Delaware, Maryland, New Jersey, Pennsylvania, and Virginia. The business that you do with Fulton stays in the local region and supports the Mid-Atlantic. We give back to our local communities, giving direct dollars, as well as encouraging our employees to volunteer their time, talent, and dollars in their respective local communities. In contrast, your current provider is vastly larger, UBS. They're headquartered overseas, and so are most of their employees. So much of the economic impact as you pay their fees goes somewhere other than the Mid-Atlantic region, if that's something that's important. You can go to slide 5. And I'm skipping slides. The program is out there for you guys to read more about, but given the time structure, we want to make sure we just highlight some things. So on slide 5, myself and Bill and Ted, we work for Fulton Financial Advisors, which is the investment arm of the bank. We have 221 employees dedicated to managing $15 billion that clients entrust to us to manage for them. They can choose anybody they want, and they've chosen Fulton. Many of them, like you, are stewards of the money. It's not their personal money. They're stewards of the money. They've done due diligence and they've chosen us over the plethora of providers they could choose, including UBS, Vanguard. There's lots of different providers of services, but they've done their due diligence and they've chosen Fulton. I specifically work in our nonprofit institutional group, as Sharon mentioned. This is a group within the group that solely deals with institutional investors. My team is entrusted to manage $1 billion for approximately 250 entities. We also have a retirement group that's entrusted to manage about $2 billion and specifically 160 million in municipal plans like yours. And that's again highlighted on the screen. As Kim had previously shared with you guys at your July meeting, Fulton has specialists, and as Sharon just mentioned, we certainly are a bank first and foremost, but we have additional services, and that's really what we wanted to share with you today. Is if you don't know us as an investment shop, that's what we wanted to share with you to let you know what we can do. As someone mentioned at the July meeting, you don't necessarily want the same person who gets you your truck loan to be your investment provider, and we couldn't agree more. Investing is a specialty, and that's why we have experienced, dedicated team and credentials. So the big credential in our field is a CFA, Chartered Financial Analyst, and we have those folks employed by our company. Slide 6, please. The 4 main pillars of our institutional services are endowment governance, investment solutions, plan giving support, and a very experienced and credentialed staff. The endowment governance piece is a lot what you guys were chatting about at the July meeting, which is focusing on your risk profile, your asset allocation. You didn't specifically talk about spending policy, but it was more a discussion about, should we be taking the risk out of these assets, kind of setting them aside, freezing them, which is not a spending policy per se, but kind of plays into that as well as when will we need this money is in your time horizon and goes into your investment policy. We believe it is our role, and we take a fiduciary responsibility to work with our clients to make sure that this discussion is had throughout our relationship and not just when things turn south like they have the last 6 months, 7 months, 8 months. It's been a rough year in the markets. Investment solutions, we have a clear and disciplined approach that can help you fulfill your fiduciary responsibilities because we're already doing that for you, as well as an unbiased fee solution. We don't manufacture our own product. We go out and find the best product to bring to our clients. And then, of course, risk mitigation, particularly in the down market, is huge, though it's just as important in an up market. We just don't talk about it quite as much. And then also custodial services. And Ted will touch more on that. Plan giving support probably is not going to be of great value to your group, though we can certainly chat about it. And then the staff, making sure you understand that this is all we do is manage money. Our clients entrust that with us. Sharon's team does different things for her clients. Our team just does investments. I think it was Mike who had mentioned, making sure that you have a specialist, doing your investments because that's critical. There was a concern raised about don't put all your eggs in one basket, and there's certainly pros and cons to consolidating things at various providers. Some of the pros can be saving time and money by meeting with one entity instead of multiple entities and retelling your story. Another pro can be potentially paying less due to a larger relationship. A con can be working with someone who doesn't provide the level of services that you need. And again, that's what we wanted to focus on today, was making sure you understood what our capabilities are before you entrust investments to us. Another concern raised was, is Fulton capable of managing investments? We're a bank, but do we have investment services? And the answer is, from our perspective, yes. Our average relationship is about 7.4 million. Was about 7.7 at the start of the year. So your $10 million relationship will be extremely important to us. You'd be a large fish in Fulton's pond. Your present portfolio at UBS in their $1 trillion pond makes you a much smaller fish in their pond. So Would you be our largest client? You would not be. We do have dozens of clients over 50 million. We have about a dozen over 100 million, and our largest client is 350 million. So you'd be in good company. Ted and Bill, I average a lot of experience, and I don't even get to the 150 years, but we're all very experienced. This is all we've done for our careers. This is not new to us. We're not rookies. And we have a group within our group, my team, that solely works with entities like yours. Dawn Lund in your UFS finance study outlined 3 ways you can increase your cash reserves, which is, part of this discussion is what do we do with cash reserves? And she shared that you can raise rates, reduce expenses, and increase your funding sources. One of those we uncovered in our review of the UBS account is in calculating the cost, you were paying about twice what you would pay to us. Now, it's our understanding that they have since come back and reduced that fee after our analysis, but even with the reduction, they're still substantially higher than ours, which begs the question, is UBS more expensive because they're better? And we don't think so, but I don't actually know. It's kind of in the eye of the beholder. What I do know is that they have more mouths to feed and more infrastructure to pay for Fulton, and that could be a reason they charge more. They have more than 70,000 employees in over 50 countries. They're best known for their private banking services to ultra high net worth individuals, including the famed Swiss bank account anonymity and multi-country access, none of which directly benefits you in Lewes, Delaware. You're just paying for services that you don't need. So while fees aren't the only reason to consider a change in providers, it is certainly one of the 3 things that your buy-in and consultant pointed out. So Ted, that's a little bit about our services and overview. Ted's going to share more about our investment experience and our team's capabilities.
Thank you, Mike. Good morning, everybody. I'm going to be on page 9, just as kind of a framework as to where we'll go. My name is Ted Walden, and again, on Sharon's comments about length of service. I've been with Fulton for 17 years and managing portfolios for 23 years. So again, a good long track record with Fulton and in the business for quite some time. Process is really important. Investment process is really kind of the foundation of any successful investment portfolio, and having confidence in that process is really important. So Mike did mention, but he normally does in our conversations like this, is that we've had trust in investment powers for 110 years now, I think. So we've got a lot of time in the saddle managing 126 managing portfolios. On timing, I can go as deep as you want on the discussion, but I'll just kind of highlight a couple of things real quick here, and then we'll circle back if we need to. The foundation of the investment process is our investment policy committee. We have 12 portfolio managers in the group. The average length of service for that group is with Fulton is actually about 10 years. And the investment policy committee is charged with developing what we start with is our long-term strategic asset allocation parameters, which are really kind of the foundation of any portfolio management process, is the strategic allocation. The strategic allocation does exactly, and I'll reference your July meeting again, as Mike did, relative to making some forward-looking statements or projections around what you expect your portfolios to do and how you expect those to perform. That's the exact kind of work that we do within our investment policy committee, running our capital market assumptions every year at the end of the year to project what we think each and every individual asset class is going to return going forward based on historical performance and volatility levels. So it fits well within what you're trying to do and determine what the outlook is for your different portfolios. The most efficient outcomes relative to the strategic asset allocation process is blending together the asset classes in a manager or in a manner that get you risk-adjusted return that gives you the best return for the least amount of risk in any portfolio, whether it's short-term, intermediate, or for a long-term portfolio. The way that you achieve that higher risk-adjusted return with the strategic allocation is putting certain constraints, upper bounds and lower bounds on different asset classes within the portfolio based upon the volatility experience of each of those different asset classes. So constraining the amount of high yield bonds or international equities or emerging market stocks that you may have in a portfolio is going to bring down that risk level, the overall risk level of the portfolio, yet still allow you to create efficiency in the portfolio for longer term success of the portfolio. So that's kind of the first leg of the process. Tactical allocation is the second leg of that process. Tactical allocation really involves kind of current economic situations and what the next 6 to 12 months look like from a economic standpoint, and then determining whether or not certain asset classes in the market appear expensive or inexpensive relative to historical valuations, and tweaking the portfolio to tactically overweight and underweight certain parts of the market based upon what you think is going to happen going forward. Finally, Mike had mentioned, Fulton not manufacturing any internal products, so to speak. You don't, for any portfolios that we manage, we don't have our clients' money invested in Fulton mutual funds. We don't think that that's the best methodology for our clients. So we hire outside managers who are the best in their specific areas of the market that they manage in, and we then use those managers to structure the portfolio based upon what we believe are the proper longer term weightings in each of the asset classes to achieve efficiency really in the portfolios. Example page 12 actually is a slide that shows you the name of some of the partnerships that we have. I'm sorry, maybe I have the wrong.
Yeah, hold on for 1
Yes,
minute.
ma'am.
I just want to, it's bouncing off and I can't, I'm not
Oh,
there.
good.
I can't do this.
Oh.
I don't know about anybody else. I'm trying
I'm
to
with
hear
you.
you.
I would close the board.
Both sides of
You want me to start over?
No. You're good, but you know what I mean.
I do.
I can't even imagine how you could even speak because everything's like.
Well, I have 4 kids. So sure.
There's a test at the end.
Okay. I'm sorry for that. Go right ahead.
That's all right. So strategic allocation is really critical. Tactical is where you can add some value to longer term returns. Manager selection, we feel is really critical to what we do. The term is open architecture. You've probably heard the term before, where you kind of start with the universe of managers in every sub asset class.
Pick and choose.
Quantitatively, you kind of delete the bottom half, and then you dig into the top half and determine who you want to build longer term relationships with. And so we feel like the partnerships that we have with the firms that we work with are built based on really a lot of due diligence up front before we go into a partnership with those firms, because we want them to stick to what they're good at, so that when we create a tactical allocation, and we know we've hired a particular manager for large cap growth or large value or smaller mid cap, that they stay in their lane where they're supposed to stay, or all of the heavy lifting of risk return and risk adjusted management doesn't work if you've got managers that are going out of the zone that they're supposed to stay. And so, right. So we don't hire and fire managers lightly. We like to have long-term relationships with our managers. But again, you have to make changes in portfolios depending upon what those managers are doing. A really good example of that is a manager that we had in large cap value as part of our value allocation earlier this year. Even in a rising interest rate environment, we felt like that they were really overconfident in the benefit that was going to be to the banks and the investment banks from an investment standpoint. So they had 35% of their fund in financial services stocks, and we thought it made a little more sense to be a little more defensive going forward. So we swapped them out of all of our clients' portfolios and substituted in another strategy to to be a little bit more defensive in this environment. So we didn't necessarily fire them because they
You
were.
just tweak accordingly.
Yeah, yeah.
Yeah.
And really, if a manager that we have a relationship with that's managing our clients' money underperforms for a quarter of two or two, doesn't mean we're going to fire them right away. We'll give them the benefit of the doubt. And
That's something you monitor?
we every Wednesday, our portfolio management group meets, and we usually have one of our managers calling into that Wednesday meeting. So we talk to, if it's not 4 weeks out of the month, it's at least 3 weeks out of the month. So
That's interesting.
we spend a lot of time. With that. So manager selection is really critical. I want to also kind of bring up a point that Mike talked about earlier too, which is your investment policy statement and offering to assist with that. The IPS now, outside of kind of the ranges of allowable investments, doesn't specify any benchmarks, and benchmarks can be really good or really bad depending upon which benchmark is selected. But I think for you to be able to measure your success from a risk return standpoint within your portfolio, you have to have some kind of benchmark to measure that against. And no matter who your investment manager is, they're never going to always outperform the benchmark, or they're not ever going to always underperform the benchmark. But that manager should be explaining to you why they have underperformed their bond benchmark or their stock benchmark based upon their investment philosophy, maybe what had happened with a particular manager's performance. But there should be some strategy involved there so that you understand why you're outperforming or why you're underperforming, and having those numbers in front of you that your investment manager is reporting to you the actual total return of your portfolio, versus wondering whether or not you're doing well with the portfolio. So I could go on for hours, but I think it's
And one of the places that really helps you is in a free falling market, where you start second guessing, woulda, shoulda, coulda. It helps you refocus to say, okay, did our long-term goals change, right? Are we in an imminent situation where we have to grab this money, which is also part of why you guys were looking to get a line. That line gives you the ability not to have to sell in a down market. So if bad event happens, you say, we have some cash on hand, we can tap the line while we wait for government reimbursement, because that happens just like that, I'm sure.
Yeah.
Wait, it doesn't.
Well, let me see, does it?
So again, as your partner in deposits, lending, and investments, that's what we can bring to the table, is to help you coordinate that. So again, it's not all your eggs in one basket per se. You're still well diversified. You're getting good advice, and it's being coordinated. That's our goal, is to help you get it all coordinated. And in this case, we can save you money. That doesn't always happen, but in this case, we can.
So it's a segue I can't let get by. I have to actually say it. And it's about flexibility, right? So our whole program is designed to be flexible. It's intended to meet your needs financially, either through a cash flow perspective, either through a capital perspective, either through a fee perspective. When we work with our clients, and you guys are our clients and have been for a long time, our goal is to make sure we're always doing the right thing by you. We're a fiduciary shop, just like you are. We have to put your best interest first and foremost, ahead of ours. And that's what we're doing when we go through a due diligence process. I think I first met Kim February, probably somewhat.
It's been a long time.
Sharon introduced me to Kim in February, and some other partners in your team, and we've been working and going through all the different facets of your organization, see where we can add some value, and really kind of deliver in a place where we're bringing our years of expertise, to help you in a win-win scenario. So when we have a larger relationship with you and your organization, the benefits to you are numerous. Flexibility being a big part, fees being a big part, and of course on our side, we get the value of having a bigger client. But this solution or this recommendation, is just one of a few recommendations we're actually bringing to the table. So we're not telling you there's only one way for us to meet your need. You know, we have 2 or 3 different ways we can kind of help out. So I completely jumped off of all the things that I wanted to talk about because
Well, it has its advantages.
yeah, I think that
So keep talking.
I'll tell you, my role, just so you guys know, is, you know, I'm the market leader for Fulton Financial Advisors in Delaware, Maryland, and Virginia. And I've lived on the Delmarva Peninsula for 55 years. I live over in Bridgeville, right? I call it, don't talk about years of service again. I've been doing it for a long time. Yeah, but my job is to go out and meet with our clients or meet with prospects and find ways for us to help. You know, and there are traditional ways for us to think about the financial services business. You know, I started in the 80s. What we did and what success looked like in the 80s is very different than what it looked like in the 90s, in the O's, and the teens, and now. You know, and a big part of that is things like, you know, eggs in one basket and specific lines and, you know, pricing metrics and all that stuff. You know, we create and do what's called relationship pricing. And what's good about our relationship pricing model is it's not tied to other pieces of business. So I think there's a slide in there, Kim. There's a slide that shows pricing on like a bunch of different things. And it's important for me to make sure that you guys all understand by looking at this. 11. So none of these individual opportunities or recommendations are tied to the other. So a question came out probably about a month or 2 ago, and somebody asked, well, if we don't go with the retirement services option that currently Nationwide provides for you guys, does that in some way mitigate the fee or the what you're going to charge us for investment management on the UBS account? It does not, right? And neither, it doesn't work the other way either. And it doesn't change the interest rate on the unsecured line of credit. Yet these are mutually exclusive products and services that we're offering to your organization, regardless of whether you choose us for these other services or not. But it's incumbent upon us to look at your full financial picture when we make these recommendations. So we've looked at it all. Yeah, and we've showed you places and ways where you can save on fees. We showed you places and ways where you can enhance benefits. And we showed, again, back to that flexibility term. You have different ways where you can provide financing without using your excess working capital in the interest of running your business, managing cash flow, providing capital. So
We'll stop. What do you guys want to know? What have we not told you that you wanted to know?
What other utilities have you provided investment services for?
So I don't know that I have utility clients. I have a number of municipal clients. I don't know. I think this is the first time I've had a utility, and I'm not sure. I live in Pennsylvania. I'm not sure Pennsylvania permits the same thing. I think when I got the first call and they said there's $10 million pool funds, I said, I don't think they're allowed to have that, are they? And I contacted our municipal group, and Pennsylvania's structure is slightly different. And I guess
I'm from
if you're
Pennsylvania.
New York,
Yeah,
is that a fair?
yeah. It's you have
So I haven't run into them because they're not allowed to do it. But we do have a number of municipal, city, county, particularly on the retirement side, the 457 plans. We have a lot of experience municipalities.
And in Delaware?
Uh,
In Delaware, you've had that experience.
we have clients. That
we have local clients that you would know if I could share their names, which I can't.
Right.
But I can tell you, I can tell you 3 very specific local big name clients that you would know in a second that choose us to manage their services in almost a very similar fashion than what we're proposing to you, which is management of excess working capital or funds with a line of credit tied to it for their convenience to use, whether they ever choose to use it or not. You know, what's interesting about that and important to understand, and I didn't get a chance because I jumped off my you know, the line of credit associated with this investment management account, if you should choose to investigate it, is very attractive because the interest rate, typically we say it's subprime, but in this world or in the commercial world, it's quoted, I think, at a SOFR plus 1.5%. But it also doesn't cost anything to set it up, and it doesn't cost anything to have it. So in the realm and the world of flexibility, you are essentially, if you choose to, making an in-kind transfer of your investment assets over to us, experiencing a minimum expense management savings in excess of $30,000 per year, and opening up a free line of credit to the tune of somewhere between $7 million and or 70% of the loan to value or the portfolio value of that account at that time. And not
70%.
70%, and not paying anything to set that line of credit up. So it doesn't cost you to have it.
It's a safety net.
That's all it is. It's a
Yeah.
safety net.
Yeah.
So,
Well, it costs you the
This is kind of,
30,000
if you want to
fee.
pass around the term. sheet,
no,
we're
actually,
talking about the
you
two
save
different-
$30,000 compared to UBS by doing it with us. If you don't change anything, if you really like the investments the way that they're sitting, you're indentured to the organizations that had that money, we can move those assets over and hold those assets for you. All we're gonna do is charge you less for the line of credit on it for you. But what we are gonna do is we're gonna partner with you in making sure that from an investment policy statement and from a risk adjusted rate of return statement, that we're in a place where we help you establish benchmarks so you understand whether or not this money is really doing what you want to be doing for you, not for us.
Before a down market happens.
Yeah.
Or before an up market happens, you say, wow, let's move the equity up because things are going well. We'll help protect you from yourself.
And we have some ideas on how we can improve the portfolio. So Bill, talking about the process of opening an account with Fulton and transferring assets is easy. But as well as the IPS recommendations, we certainly have some ideas on how you can improve the portfolio.
Did you say York was one of the municipalities you have, York, Pennsylvania?
I don't know if they can.
York?
They can't disclose.
So,
I'll tell you that.
Huh?
so
You can't
we
disclose
have
the
a
name.
number of municipalities.
The reason I
Without
asked was because I'm from York.
Yeah, but they can't tell you.
And my office is right next door to the Fulton office in York.
Okay.
Katie said she can provide references if you like them.
Other questions for us?
On the secured up to 7 million or 70%. I know when we had talked, if you have a larger expense that comes up that's not planned and you have to use the line of credit, if it is a larger expense, one, you have the ability to hold it, pay the interest until you receive funding, or vice versa. If you need to, you can term it out after 1 year, because that's when we have our meeting. Yeah.
That's correct. That's correct.
Again, the purpose of that particular line was the answer to your guys' question about, hey, we'd like to have this, help us figure out how to structure it. And then we offered various options. And I think that may have gotten a little confusing about, wait, what's this one versus this one versus this one? So that we apologize. We speak banker and investments all day, and we sometimes forget that not everybody else does. So for that we apologize.
No, we don't mind. We bring you down. We do not mind. You will not talk over us. So that's not a problem.
Also, in the interest of clarity,
Yeah.
I think it's worthwhile repeating. The initial request was 5 million, if I'm not mistaken, right?
Did we
That's-
make?
That was,
Well, it was 3 and 1.
I can't remember. Did we
three
make an
and,
initial request?
I don't think we
Or
ever,
what we were chatting.
No, it was
we were
Yeah.
ballparking a number out
We-
about
yeah,
5
we
million.
ballparked.
Yeah.
1 was equipment.
Well, no, this was before we even got.
Oh,
This is before
This,
this even
we,
happened.
we sat down, at our annual meeting just to kick off, and we had thrown out the idea of one of the things about flexibility piece was to be able to have a line of credit, because
Right.
you can't predict, storm comes, doesn't matter if you
Yeah.
got $15 million
No,
in the bank, it ain't
right,
gonna
There's
occur.
no relevance.
So to that end, we were originally talking about a $5 million line of credit. And what we figured when we went back to the table is that, okay, we could comfortably produce a $3 million unsecured line of credit, but we couldn't get as high as 5.
Mhm.
So then we said, okay, they really wanted 5. How can we find a way to get to 5? And I said, all right, let's look at this and this, collect up these statements and assets, and let's see if we can do it this way, because we do this with a lot of other nonprofit corporate clients. I said, if they have it, it may be a way that we could use it to leverage both sides of it and give them, maybe they save some money on fees, maybe they don't, it just so happens you would. And then the other side of the coin is then maybe you can get a better line of credit. So now we're in a circumstance where we're coming back and we can say, okay, if we can give you a $3 million line of credit, SOFR plus 2, I think, and, you know, legal fees and setup costs and all the rest of that stuff. Or we could just move this money over, save you a whole bunch of money. And at the same time, you know, get you a really attractive rate on a much larger line of credit that doesn't cost you anything to have unless you ever use it. So, and we probably, I'm not gonna speak for Katie online, but we may even be able to make it even a little bit better. You know, we honestly may even be able to make it, you know, a little bit more attractive, maybe able to do something with the unsecured piece on top of the secured piece. So you'd really be in a good spot when either something blows through and knocks the water system out or knocks the electric poles over. And you don't want to wait on our friend down the road to write a check and get it to us.
It's
So
MDF, so I had a little bit of wood in there.
that's kind of, I mean, that's kind of.
Other questions for us?
Hey, Richard,
Yes,
I have two questions if you don't mind.
please, Mike.
One of them has to do with the line of credit. Have you a facility for a secured line of credit, and how would that differ from the unsecured line? I'll hold off on the investment question.
The difference between the secured and unsecured, I think is what he did.
Oh, simple. $3 million unsecured line of credit, SOFR plus 2, plus closing costs and attorney fees.
How much is 3,000?
3,000.
3,000.
3,000
Yeah.
for the
And they
unsecured.
have that, and I can actually send you a soft copy.
Okay.
If actually Margot's watching, she can actually shoot it to you.
Is that
An
what you
email if
were
you want to
asking,
put it up
Mike?
in there.
Is that what you're asking, Mike?
Well, I guess I'm way out of the knowledge base here, but you're talking about an unsecured line of credit. I'm just curious, the rates are lower on a secured line of credit and how that would differ from an unsecured line of credit in both size and cost.
Yeah, that's what he's asking.
So using the secured line of credit, the interest rate on that SOFR plus 1.5 with no fees to set up and no fees to hold it, interest only when you choose to use it. And we would be securing that with the investment management account. The unsecured line of credit is priced at SOFR plus 2 at $3 million with $3,000 in bank fees and attorney closing costs to establish.
And Mike, you guys have a term sheet that lays all this out. You don't have to be scribbling down notes while you're listening to the roar of things at your house. So you guys have a term sheet with this information.
Great, thank you. My second question is an investment question. Like any organization, the Lewes Board of Public Works has a series of liabilities that are needed to be funded by either income streams or those asset pools that we were talking about. When you guys are thinking about the construction, the nature of the investment pool, how do you think or incorporate in the nature of the liabilities that they're trying to fund through those? And do you offer any kind of insights or views on how organizations like the Lewes Board of Public Works can establish the nature and size of their liabilities? And I'll just to kind of make sure the question doesn't get lost in the in the discussion. Most defined benefit pension plans would hire an actuary to help establish the size and nature of the pension plan, of which an investment portfolio can be designed to be managed in a hope of funding those liabilities over time. Obviously, the nature of the liabilities that the Board of Public Works faces are much different than a pension plan. So I'm just curious how you guys would think about that in the design of a portfolio.
Well, I think, Mike, are you talking about the use of the longer term portfolio to do that, or shorter? Yeah, everything. But if everything is the case. We don't do the actuarial work, but we can help you with portfolio construction and whether or not that means allocating a certain part of the assets that you have to offset those liabilities. But I think the challenges today still remain, even though interest rates have come up a little bit, they're not what we're used to, 20 years ago, where
11 and 12.
high grade corporates could get you 7.5 pretty easily, and that's not the case today.
Can I draw a line just to make sure that we're being clear? So we're today we're really just talking about your excess working capital account. And I'm glad to talk with you about your DB plan, you know, and the accounts that you have with Nationwide, but you saw about the pension.
That's just hedge table. So,
Oh, okay.
so in helping you decide what your risk tolerance is, you know, to create your asset allocation, we need to talk about what's the goal of this money. You know, it's a safety net. What if this happens? What if this happens? What if this happens? And that's in part what the line is there to do as well, because prior to having, you know, until you have the line, right now, it's either cash or sell assets. So this discussion has already been going on, which is what brought us to put a line in there. That gives you one more tool in you know, arrow and quiver. So we are going to work with you to do that. What we don't have direct capabilities of, Mike, is helping you figure out what your potential liabilities could be. And we can certainly discuss that with you. We have a lot of economic experience and backgrounds. I'm not sure that we have direct experience, like you were saying, your example of an actuary for a DB plan. We actually have a lot more experience with that. I don't know that we have a lot of experience helping you figure out, you know, what if the whole Route 1 string of poles goes down? What's the liability to fix that? And then deal with Del Dodd and everybody else. I'm not sure we're equipped to do that, though we're certainly happy to weigh in on conversations with you about that with, you know, other experts. But the asset allocation side and what to do with this $10 million to help you in your future, setting goals, objectives, risk tolerances, that is directly in our wheelhouse. And that is directly what we feel is our fiduciary responsibility to our clients. Does that
what he?
help answer? I'm not sure if that answers his question or
No,
not. That's all.
Yeah, I guess I probably asked a maybe a little more general question. The early part of your presentation, which I enjoyed listening to, was kind of laying out, at least from my point of view, a holistic picture of your capabilities, and I think that was helpful. My question was more around when you're coming up with an asset allocation for a client. If the client is a pension plan, that asset allocation could look a lot different than if that client's an endowment, or if that client's trying to manage working capital, or if that client's a utility trying to manage a long-term project funding. And it's not always, and I know you guys know this, it's not always one allocation fits all comers. All those liabilities that I just gave you all act and behave very differently and have different challenges in trying to establish their size. And I was, as you guys were talking about your entire offering, I was trying to think about whether there might be any tools or services that you offer to help an organization like the Lewes Board of Public Works get a hands on the nature of their liabilities. And a lot of those managers that you showed were not cash managers or short-term cash managers. They were long-term managers in a more traditional asset allocation. But I'll leave it there. Thank you.
That's fine. Other questions?
Could you take us from a nonprofit to a for-profit corporation?
Help you through that process?
Yes.
Or help you change your investments accordingly?
Either.
Why
we can't do
That's nothing we can do.
Trick question.
Yeah, that's true, because you can't go there.
First of all,
I think we all know that one. I'll be a prophet today.
Other questions? You were up.
That was pretty good.
Or concerns, really. Do you have any, we want to hear your concerns. We're very interested in whether or not this, does this check the boxes for you? Does it not?
Let's back up for just a second. So Mike's question about shorter term investments, because of his comment about these being mostly longer term. So Mike, we do have a group called our Cash Reserve Investment Management Group that manages short-term money for municipalities, primarily corporate clients.
Yeah.
I'm sure there's 5 or 6 others in that group, primarily with 0 to 2 to 3 year durations on those portfolios. We have 2 dedicated PMs in that group. So not to say that if we're managing your longer term portfolio, they're not going to manage part of that portfolio. But if there are other dollars that you are looking to match versus liabilities, we do have some capabilities on the short-term investment management. And we've been doing that for
We find,
a long
Mike,
time.
that groups tend to recognize some of these names better than those institutional managers. So it's somewhat salesman-y on our part, but most people have heard of Vanguard and TIAA and PIMCO. Most groups have not heard of the specific capital market, kinds of groups. So
Well, to that end, we have more than a handful of local municipalities that choose us in that space for that product.
for just the short, ultra short.
Just that short-term funding. So case in point, if there's a $2 million grant coming in from the Fed that they're going to receive in June or September, and they don't have it earmarked for a project yet, but they're going to put it on the table for something that's maybe 24 months out, we have the ability to put that money to work in a window from 12 to 24 months.
Pending to 2 million.
Exactly.
Mm.
Whatever
But
happens.
therefore,
Oh, whatever.
You wouldn't be in the stock market.
Right,
Yeah,
gotcha,
You don't belong
gotcha.
there
Right.
2 years or less.
So it's a way for you to generate
Yeah.
a higher yield on cash assets while maintaining,
Right.
preserving the asset, so to speak, but not having.
It's
it
just
to
a
fund your
security
operating-
blanket.
And
Yeah,
it's
I got
becoming a
you.
lot more attractive now because rates are rising. So for the
Oh,
last
yeah.
15 years, with
Mhm.
rates being compressed and then artificially held down, this solution wasn't as good a solution for most clients.
Well,
Yeah.
no,
So we were
there was a
looking
need.
for other solutions.
Right.
Well, it preserve principal, but like bank deposit, there was no return. And
Well,
and just like
really?
say, the short rates are coming up, it becomes more attractive.
Okay.
Which then we could talk a lot about. And if you work with us, we will, but another day. Other questions for us? So I guess
this has been very helpful.
is this Katie
Yeah, I
chiming
think
in?
Katie wanted, she
Somebody's
has
on
been
there.
trying to talk and I know.
Yeah.
Sorry,
She's-
Katie.
She's on there now.
Thank you. Can you hear me?
Yes.
Awesome. Thanks so much for allowing us to spend some time with you today. My comment in the chat or the question was just if I'm understanding the question correctly, one of the things that we can do is obviously provide both support and guidance about potential changes to your investment policy that would be driven by changing needs of the Board of Public Works. So again, that's only if I'm understanding the question that Michael was asking earlier. But we very much value the relationship that we've had with you guys for a long time. Very much appreciate it. Don't take it for granted. As I indicated, we would have to get permission from those other clients, but we certainly can provide references for both the line of credit support as well as for the investment management, if that's something that you would like us to provide to you. So again, I just wanted to say thanks for having our team here today. I'm sorry I'm not there in person, but I figured you didn't really need an army of Fulton bankers bigger than the one you already have. And we really look forward to hopefully continuing to enhance our partnership.
Well, thank you very much, Gene.
Thanks for
Mhm.
that.
It's
Pleasure.
been a lot of information to absorb.
It's all in writing. And we tell questions.
Yeah.
That's why we did that.
Very well
Will we
presented.
get a long-term customer reward card for this?
Oh, wait, we know how that works. Thanks, folks.
Thank you.
Yeah.
Daniel.
Yeah.
Thank you.
Thank you.
Absolute pleasure.
Yeah,
Thank you. Thank you. Thanks very much.
Thanks. Thank you very much.
Nice meeting you. Pleasure meeting you. Thanks very much.
Thank you very much. Thanks for showing.
5 minutes. You were on top. Find it up. Yeah, I watched. We were I was like, you guys- I gotta pop the DVD player.
Thank you.
It's 5 minutes. Yeah, I grew up in Leadership.
Thanks, Jeff. Have a great rest of your day.
Thank you.
Open and close.
Open for right now. No solos. No. That was really rough there. Wow.
So the next item is just a repeat request for any reference for filling the remaining 2 committee slots for volunteers for the financial committee. So if it's an open question, it doesn't have to be committed to at this particular meeting. Just contact anybody on the committee, or
So you're looking for two more folks.
so.
Do you have to have the two others to make it? Hmm?
No,
Mm.
it's a
No.
flexible
It's
number.
just a question,
Yeah.
okay.
We have a lot to offer.
Don't start. You gotta go there, right?
Yeah, every time.
Can you put that up?
Mhm.
If you haven't first. So the prioritizing of the policy. This was the original page of asterisk tasks, policy tasks by the board for the committee to look at. And I've double asterisk. I've double asterisk what I believe what we are now pursuing will better inform us to deal with those double asterisk items, which leaves very specific remaining items in the hereafter, such as the lien forbearance for special projects, reimbursement for extension of utilities as separate, distinct discussions. I think to continue on with what we have started, and can you put that other, which is the scenario analysis, will yield better results. Just this single thing for now. I had just put together, with the help of Mike and Kim and Austin, a written summary of where we are and where I think we're headed. Mike had helped us organize a scenario analysis based on the capital projects and the O&M year forecasts, which were updated in beginning of August. And using the water department only as a standalone division to see how we can better look at the framework of the pluses and minuses over 10 years and identify ways to better forecast the future using best case, worst case, realistic 1, realistic 2 as a mathematical process. And then creating this fifth forecast expected using the weighted averages of the above 4 different forecasts. And then following on with 3, 4, 5, and 6, leading to 7, which is the plan is to conduct the same 6 steps for sewer and storm wastewater treatment plant, stormwater, and electric. And that will begin to give us the complete framework of a forecast for a better balance of liabilities and assets. So if Sharon, you could put up the expected spreadsheet that Mike had consolidated. And Mike, if you could kind of walk us through quickly how we got here and the reasons behind using this mathematical scenario analysis. that would be helpful.
Sure. So I want to be careful about saying mathematical analysis. While math is involved, what we really have here is a framework to help us think a little bit about the future. Almost many things in life require that we have some prediction or at least some sense of where the future is going to be. Some of them are trivially easy to do. For example, I can bet with almost 100% certainty that the average height of 20-year-old males will be taller than the average height of 20-year-old females a year from now. But I'm a lot less confident in what the level of interest rates in the US are going to be a year from now than I am with that trivial analysis or trivial example that I gave you. And so there's a lot of different techniques to try to come up with some view of the future in some coherent framework. Many of you will hear that the Federal Reserve is forecasting the future of inflation rates and things like that. They use statistical techniques called econometrics. There are others that use time series analysis, which takes a look at long-term history and try to decipher patterns in that data. It's commonly used in some of the areas of financial markets. But in this particular case, the tasks that are hitting Austin and Kim about trying to get a sense for the future cash flow needs of the organization, I think the technique called scenario analysis is probably the most appropriate. And that was the analysis that we utilized here. But in order to do scenario analysis, it forces you to come up with a set of future possibilities that aren't holistic in a sense that it was every possible thing that could happen, but they try to capture some of the big events that we could face in the future. And then in some way, weight those events to come up with a weighted average of the future. And that is kind of your best case. But another power or a power of a couple of things that make scenario analysis, I think, powerful in the context that we're talking about. It is a very transparent framework. When Austin has a dollar projection for a particular project or a revenue projection, they are explicitly stated. Everybody can see them. It's very crystal clear. It's not a black box in the sense that there's just simply a number out there. The second thing is, by doing scenario analysis in the way that Austin and Kim have done it, we're able to try to understand the uncertainties we have around the future as well. When you have an uncertain future, the average value is a poor characterization of what that future might hold. You have to have some sense for the uncertainty that you're facing as well. And so maybe if we could just take a look at realistic one for a moment, Sharon.
Yeah.
Realistic one, if you scroll down, Austin and Kim have broken up the water utility into two sections, water infrastructure and what Sharon just had there, water production. So they have they've broken it up into two units. Each one of them has its own cash flow needs in the future and its cash and its revenue generating abilities in the future. And so obviously it's a little hard to look at this spreadsheet because I'm only looking at one line here, but if Sharon scrolls up a little bit, you'll notice that there's a series of, keep going. That was revenues. We just looked at the revenue section of water infrastructure. Now she's looking at their water infrastructure costs.
Mhm.
Those are a foundation of one particular scenario. Is there an easier way to?
Unfreeze the rows up top.
Hold on here.
If you unfreeze it, you're going to lose your years, and I think that could cause a confusion as well.
But I need to fix this.
Yeah. Well, maybe I'll just continue on as far as kind of just philosophically what we're trying to do here. Austin and Kim have worked through 4 scenarios. There's no magic number on the scenarios. You can have 10, you can have 2, you can have 3. It's whatever you feel is necessary to categorize or characterize the environment in the future. Kim and Austin chose 4. After they had come up with the values for the cash flow needs, if you scroll to the bottom of that page, stop right there. We aggregated those up into the net cash flow needs for the water infrastructure component and the net cash flow needs for the water production component. So that gives you some sense for the red, by the way, is the negative, meaning that the revenues are not large enough to cover the costs, and the black numbers are revenues are covering the cost. So at the end of the day, it is probably the red numbers that we're most concerned about. But you can look at each individual scenario by itself. There's a couple of interesting insights you can get from doing this kind of analysis. And so if I can get you maybe to switch over to the best minus worst page or tab. In this particular example, we've taken the best scenario and we subtracted away the worst scenario. And what that helps us do is to get a sense for where we have the most and least confidence in our predictions. And so, Austin, if you scroll to the right, you'll notice that the numbers that fall under the water infrastructure expenses, which is what we're looking at right there. The uncertainty around those numbers between our best case and worst case scenarios is huge. The difference at that $15 million there gives a sense for, down on row 25, gives some sense for how far off we think we could potentially be in the future on estimating these expenses. Now, if you scroll down to the next block, these are the revenues. You'll notice that the revenues on the water infrastructure, the difference between the best and worst case scenario is only about $2 million. So if I was to just look at the water infrastructure component of this, I would say the real big uncertainty in our future view is coming from the expenses on the water infrastructure area. Now, Austin, if you continue to scroll down, we're getting into water production. Now stop there for a second. The $28,000, which is all the way to the right, is the difference in expenses between the best and worst case scenario in water production. So that's $28,000 versus $15 million on the water infrastructure. And so when I look at this, it feels to me like the real uncertainty in projecting the future for the water utility is coming from the expenses on the water infrastructure. And those numbers dominate everything. That's really the big uncertainty in this particular utility. So those are some of the insights you can get from doing this kind of analysis. And I want to stop there for a second and see if anybody has any thoughts or questions.
And Mike, when I did the spreadsheet, I should have broken out that O&M. That applies to both the infrastructure and the production.
Okay. So we may be able to, yeah, sorry, go ahead.
It's however it breaks down.
Okay.
If you look at the net flows, which Austin was just at, and scroll to the right, you can get some aggregate numbers over the 10 years. So best versus worst case scenario, those give you the sense that the best case, we think we're going to be $21 million better over the 10-year period than the worst case scenario. So fairly big delta. And as I said before, most of that uncertainty is coming from the water infrastructure component. Now, it may be that with more work, we could get a better handle on the water infrastructure costs and try to reduce some of that uncertainty. That doesn't mean that the number won't still be huge and negative. It just might mean that we can get a better idea where that is. Or it may simply be that that's as good as we're going to be able to do on the water infrastructure expenses, and we're going to have to live with that. And that's why I was sort of saying, if we take an average of all these different scenarios, the average is just a simple number. The average is a bad characterization of a really risky or really uncertain future. In order to get a better characterization, we also have to have some understanding of how off we can be. And that's what the focus or the effort in this best minus worst is trying to give us a sense for. Now, if you go to the expected tab, the expected tab, for those of you that either had statistics or still remember some of your statistics from school, you might think of a distribution having a mean and a standard deviation. The mean of a distribution, and that's the way, by the way, a distribution is how a statistician typically thinks about uncertainty and risk. You could think about this weighted average of those four scenarios as effectively being the middle of that distribution. And that best minus worst is sort of giving you some sense for the spread in that distribution, how wrong you could be and how large that mistake could be. And so I look at the expected page, which is this one, which gives us kind of a weighted average, the middle of that distribution, and the best minus worst is kind of giving us the risk or the uncertainty around that distribution as two components that need to go together. If we go down to the bottom of this page where we have our net, to try to make this digestible, this net is laid out fiscal year by fiscal year, and then to the right, it's the 5-year, the first 5 years, the next 5 years, and the 10-year aggregate values. So, well, anyway, let me stop there for a second. Does anybody have any questions or thoughts?
No, we just.
The infrastructure is still driving that 2.5 million shortfall.
That's right. Now, I may have been over the line when I talked to Fulton, but it did feel like the beginning of their presentation was all about how they can help nonprofit organizations, and they threw a lot of stuff out there. And that's why what I was really asking them about, or one of the questions I was asking them about, is do they have the ability to help us think about the future? Maybe they have a different technique other than scenario analysis, for example, they may recommend. The second thing I wanted to ask them related was, it's not enough just to simply have these dollar values. These dollar values, you may have an investment portfolio helping to fund some of these shortfalls. And so I was trying to get a sense for them about what other tools or what other services or what other insights they may have. Most of what I heard about their asset allocation, the investment policy statement and all of that is pretty plain, pretty plain stuff. There might be more there. I try to give them an opportunity to talk a little bit more in depth about asset and liability analysis, which would be more pertinent to what we're talking about here now, but they didn't seem to either want to go there or perhaps just don't have that kind of capability.
That's what I think.
Yeah. Now, one problem with using information like this, and let's just look at these expected values for a moment. $1 in the future is not the same as $1 today. And maybe to kind of give you an intuitive notion of that, if somebody said, I can give you $10,000 today, or I can write you a check for $10,000, or I can give you $10,000 10 years from now, which one would you take? It's kind of a silly question, but any rational person would take the $10,000 today and not wait 10 years to get that. There's a chance that whoever offered that might be long gone. There's a chance that inflation might greatly erode the value of that 10,000. It might be worth a lot less 10 years from now. There's a whole host of things. And your $10,000 given today, you could invest that. You can put that in a government bond and you'd actually have more than 10,000 10 years from now. So any rational person would take the 10,000 today versus the 10,000 in the future. And because of that, because the fact that $1 in the future is not worth what $1 today is, we have to somehow, when we're thinking about these numbers, put these values in a common language. We have to put them in today's values. In the finance world, that's called a present value.
Present
What-
value, future.
Present value and future value. What Kim
Yes.
and Austin are showing in this table here are future values. They didn't try to create present values out of that.
Oh,
But when you look at your investment portfolio,
oh,
let's say you're invested in an S&P 500 stock index fund, and you have $10,000 in that fund. Most finance people believe that in the long run, the value of a stock like General Motors stock or Apple stock is the present value of its future earnings.
yes.
And so we would oftentimes say that if you were to invest in a Vanguard index fund, and let's say you had $10,000 in that fund, you were actually investing in the present value of the future cash flows of the companies in that index or in that fund.
Okay.
We have these values that Kim and Austin laid out are the future values, future liabilities that we think we're going to face.
I didn't realize,
Is that Mike? Mike, is that because
I didn't realize.
Kim and Austin have already inserted inflation and or expected increases along the way, the further out the forecasts go?
Not even that. It's even simpler. If you just simply talk about a $10,000 value 10 years from now, whether you have any inflation or anything in it, it's worth less than 10,000
Yes.
today.
Yes.
So just the fact that they put future numbers out, regardless of how they've got there, that value is worth less than it would be today. In other words, we have to explicitly convert those numbers into a present value through a technique called discounting.
So the 20 million in this example is not 20 million
Today,
in 10 years. It's presumably a lot less than 20 million.
It would be less than 20 million. Yes.
20,
When we convert those, when we discount those numbers back to today's values.
it's lower.
But it's not going to be a lot lower, so I don't want to get everybody excited. we just
You
cut the liability in the third. What I'm really trying to say is when we're comparing the size of the liability, you can think about these as a liability. When we consider the obligation that the Board of Public Works has in the future, and we want to compare that perhaps to a pool of assets that we have sitting there today, in order to make them comparable, we have to be looking at them both in present value terms. Your investment portfolio, because of the way financial markets work, already is in present value terms. It's the present value of the future cash flows of the companies in that portfolio. But these liabilities that Kim and Austin put together are not automatically present values. They need to be converted into that. So that's really why, and that's really the next step in this process is to create present value values out of these.
Gotcha.
I
That's
realize that this is the first time you've heard this kind of stuff. It could really sound way out there, but it's not uncommon in the investment field. But please ask questions.
I don't have a problem with it. I have a concept, present value, future value, because I'm a finance major. And I'm sure that El Lorraine does as well. So I know what you're talking about, but I'm glad you clarified that for me.
So
To tell me that these numbers were based off future value numbers, not present value numbers.
Yeah.
Thank you.
So if there are future value numbers now, and the present value translation is less than 20 million, will that less than 20 million actually purchase the same capital program infrastructure that was anticipated?
Yes, because the idea would be, let's just say, for example, I'm going to throw out fictitious numbers here, but let's just say that $20,679,000 that we're looking at in row 065.
Right.
Let's just say we discount that and now it's really 10 million in present value terms. What that really would mean is if you had an investment pool of $10 million right now, and you invested it in the appropriate way, it would over time grow to match to that liability. So let's say you invested it in that's a 10-year number there. Let's just say you invested it in a 10-year government bond that yielded 5%. In other words, that investment pool would grow to that future value over time. And that's sort of connecting future to the present value of a liability.
And that one comparison of the present value today of the 20 million, is that enough to I don't know, smooth out and solve the issue or mitigate the issue that to turn the 2.5 million total into
Red
a
to black.
black?
Yeah, I thought that's what you were thinking.
Yeah, I very much, I don't know the answer to that because at this stage, first off, that number will still be negative. I just don't,
Yeah,
it'll be less negative, but it will still be negative. But what I don't know is what assets you have, whatever that number comes out to be, and let's just say it comes out to be negative 2 million instead of negative 2.5 million.
Right.
The next question is going to be, that's the liability side. What assets do you have to back that? Or how are you going to close that gap? If you happen to have, let's say that number discounts back to 2 million and you happen to have a $2 million pool sitting in treasury bonds, you might be in pretty good shape. There's some technicalities here I'm trying to oversimplify right now. But you might be in pretty good shape. On the other hand, if you have no assets, investment pool, you still have $2 million that you need to figure out how you're going to plug.
How you gonna
Okay, so
Girl
let's
Scout.
say you've got that asset now that you designate to solve the 2.5 million 10-year number. Is that the real key to smoothing out the interim 9 years of red also?
No, it's not. And that's where the behavior of cash flows is going to be important. In other words, many investments have a huge negative cash flow right out of the front, and the payoff is much farther in the future. So long term. So the behavior, time series behavior of these cash flows is very important as well. For example, if you put that money in a bond, you'll get a coupon payment every year or every 6 months for a treasury, but you're actually not going to get your principal back to the end of the period. But you may need that money long before then. So we have to understand the behavior of the cash flows as well, which, in other words, the behavior of the liability, and by Kim and Austin laying this out year by year, that will give us more insight into that. If they simply just gave us, here's the 10-year number, we would lose, any insight into those, intra-period cash flows. So we've got more work to do there. The second thing, go ahead, Richard.
I understand present value. And my experience of it has been using it for investments. What we're looking at here, however, we're looking at expenses that are spent or supposed to be spent. So we don't have, 2 million today that gets to be 20 million or whatever in 10 years or whatever. What we have is an expense that creates a 1,565,000 loss. And the next year we have an expense that creates the loss and so forth. So if these are, we're not investing the money in a present value. At least I don't see it that way. I'm not sure I understand the words and I understand the concept of present value, but I don't understand how it applies here because these are expenses that are, need to be spent in whatever year it is that we're talking about. So the money isn't going forward, it's being used.
Yeah, so Tom, I think what you're saying is, and this is my naivete on how the Lewes Board of Public Works is structured. You may be saying that there is no assets. It's just a whole. Because what we have been talking about in the past was if we had an asset pool, what would that pool look like? What would the structure of those assets look like to fund this liability? If you're telling me there is no assets, that doesn't negate this analysis. That just is what it is.
Well, we do, what we do have is we do have our cash reserves. And that is something that can be invested.
But-
So in long term, so that certainly can grow. But the analysis to get of all of the different projects and so forth of income and expense, if you come out with a loss in the year you're looking, in which you're looking, you've got a loss because you've already spent that money.
Well, you don't
And the
have a
next-
loss in the sense that this is a liability. And if you have, so let's say the liability is $2 million. If you have a $10 million cash reserve portfolio, I would say you're more than covered.
I don't understand, but I mean, from a present value standpoint, that money is gone. It's not invested anymore.
Well, the present value analysis is nothing more than to try to get the liabilities that the organization faces over the next 10 years into common terms with the asset portfolio you have to back them.
Okay, now I understand that. Yeah, all right.
And just for specifics, I did pull August numbers without the month end from UBS for water, for restricted and unrestricted, and the reserve funds is $2,052,000.
That is what,
Now.
when we break down our
Okay.
cash accounts,
All right.
that's how
Talking
it's,
about now.
yeah,
Not
to-
considering our operating account, just our
yes,
reserve.
that's just reserves.
Okay,
What's invested.
all right.
So to really
part is-
understand an organization, you've got to understand the nature and characterization of both the assets and the liabilities and how they work together or apart.
Right.
Right.
Mike, does the same apply to the income, the 18 million number, that has to be adjusted to present value?
It would be the way I think we should do this, because the nature, when you look at these 10-year numbers and these 5-year numbers, it may be that the revenues and the expenses aren't nicely lined up. That in aggregate, they kind of work out, but they might not be lined up, year by year. So it may make sense to discount the streams individually. So we still have that time series.
Okay, so
yeah.
maybe it's a step process that you start with the first negative in column F of the 209,000.
I guess all the way the first year.
Yeah.
It's just
Come on,
not school.
Well, okay, we start with the 1,000,002 and solve that asset issue some way, and then go to the second year and with the goal of getting everything in the total line to be black
Yeah, it's
by,
not.
by various asset
So this year.
structures
yeah.
So
This,
that one.
that
discount is
that
much, but as
address
you keep going,
different,
discounts Are gonna get higher as well with uncertainty.
total
of course.
years.
Which is gonna be.
So you're thinking about it right to a point, Richard. The I wouldn't do it. Well, let's get rid of let's take care of the first year and then we'll move on to the second year. I would still look at it as a in a holistic picture. But we could take an investment portfolio, let's say the cash reserve portfolio, and create an income stream out of it. So for example, if you have $10 million in the cash reserve portfolio and we need 1.2 million in the first year, we could pull 1.2 million out of the cash reserves. We basically created income out of the present value of those assets. I know that sounds trivial, but that's kind of the way we would think about this.
Okay,
Now, if we have a shortfall, if let's say Kim came back and said, you know, we've got a $2.5 million liability here over the 10-year aggregate, but we only have $1 million in assets right now, then you guys have a mismatch, or you guys have a shortfall, a funding shortfall.
right.
And that's when you move into a world called financial planning. And you start to say, well, okay, this is the situation we're in. What are the levers we have to pull to close that up? Do we raise rates? Do we make a more aggressive investment portfolio? Do we hold off on some projects? Do we, you know, those are things I don't really have any insight in, but trying to recognize where you have a shortfall and the magnitude of that shortfall, the earlier you recognize that, the more options you'll have in front of you to clean it up. If it hits you in the face, you don't have any options. You know, it becomes a fire drill. And part of this planning or this process is to try to move from fire drills to financial planning, you know, strategic planning.
And that's what Fulton was trying to push as a, you know, as a resource that we could use as another consultant, if you will.
Well, no, they didn't actually do that. And I gave them the opportunity to do that. What they're basically doing is running a basic plain vanilla portfolio. And it may or may not look anything like the liability stream that you're facing. And they don't really have the tools to help you understand that liability stream like we're trying to do here now. So
Right.
They may be part of the puzzle. They're not a holistic solution to this. The other thing I want to make sure that nobody loses sight of, and I said this a couple times and I'll say it again, an average value and expected value, which is a weighted average, is a poor characterization of a really uncertain process. So you have to remember that even if we discount our liability back to present value and it's 2.5 million, and we happen to have a $2.5 million portfolio, that'll be great if we get this average. But what if we get a worst case scenario? We're going to be super underfunded. And so I wouldn't just completely ignore that. I think in the financial planning process, I think we should say, look, we realize this worst case scenario is not completely out of the question. So if that's to arise, you know, what should we do? How would we think about it? How would we plan? Or is it a big enough risk to the organization that we want to make sure we're overfunded from our expected value? In other words, that we have more cushion to help, you know, cushion a loss? Or is there insurance that we should be taking on? You know, should we try to mitigate that risk, not by self-insuring, by building a huge investment portfolio, but by paying for insurance? You know, that's financial planning that would need to come. But I don't want people to lose sight of these scenarios that we ran.
Okay, so if this were the only division, water, that we had, what would be our next step using this net cash flow evaluation, the way it
Well,
is?
discount these to present value terms.
Yep.
We would look
Absolutely.
at the size of the portfolio that you currently have, and we would look at the payoffs and try to determine if we could hit these cash flow needs over the next 10 years.
With just that portfolio as the one and only source?
No, well, that's where you start. And you try to get a sense for where are you. Like I said, if you guys have a $2 million liability and you have a $10 million portfolio, you're pretty golden. You could probably have your worst case scenario and you have no issue. You've overinsured for the future cash flow needs. On the other hand, if you have $1 million portfolio backing a $2 million liability, you're greatly underinsured and you better start determining how you're going to fill that hole. But that's our next step.
Okay, so the next step is that we start with 2023, the 1,000,002 shortfall, and a reserve fund of whatever, 8 million, let's say, and do a set aside of, okay, we're gonna take 1,000,002 out of that, so we have whatever the difference is, and then we go to 2024 and we do the same exercise, and we
That's where I'm
see
going to
how-
give you I have to give you the discounted value, the present values of each one of those, not the future
Yes,
value, which is on this
That's
sheet.
your next move is doing the present value of these.
That's right.
existing numbers.
Do I take the present value of the 2023?
Yes,
It's the whole
Yeah.
thing.
the whole
All
thing.
okay.
You do present value of everything you
so-
have up there for realistic numbers.
Okay,
That's
so we add another line underneath the total of that present value going across
That's right.
of just the bottom line.
That'll give you reality.
First of all, because you're not changing anything.
Well, it's not
in
even a matter of changing,
revenue
it's a matter of
or-
dealing with realistic numbers. What you have there is the future value of what it would be, but what you really need to look at is what the present value is, so then you know where to move next.
That's
So-
right. That's the next step.
Yes,
so-
exactly.
Okay, so do we then, from here, these three lines, we translate them into present value and make another chart going across below.
You don't need another chart. You can use this existing chart, just simply do a present value on it. You don't need another chart, guys.
Well, I think what Richard is suggesting is Caroline's right on. We need to get these in the present value. But we could actually, we could present the present values in a table that looks exactly like this.
Yes.
Yeah.
Because there may be other adjustments that pop out that, oh, you know what? That water infrastructure in the second or the third year has either gone up or down, you know. Maybe there's some things that we want to know. Well, just the translation, you know, erasing this line and putting in without the reference.
Oh, no, you can leave it so you can always see what it is.
Yeah.
and Drop a line.
Yeah,
under it,
you'll
is
have a
what you're
comparison
saying,
Yeah.
right?
tool next.
That's
That's
what
what I
you're
want.
saying.
That's what I want to see.
Yeah, that's,
See the
we're on the
different
same,
numbers.
yes, that's why you
Okay.
saw that, same sheet.
Okay.
And also in the,
And then use that analogy of, okay, the first of the 23, what is our pot of money
Mhm.
until it runs out or
Goes in the red.
goes into red
Yeah, because
again.
then it'll be real.
And that's the point where, there's the first, if everything stays as it has progressed. That's the first place we've got to add an asset to cover the liability
and
in
then
that year.
in these scenarios, I am financing all the large projects. So it's about $22 million of funding in 10 years. 15 million of it coming from Cedar. And I used
Oh, yeah, I
an
saw that.
SRF loan, even though we might not necessarily be using an SRF loan, but termed out for 30 years at a low rate. So that will also, it's gonna be a whole bunch of different scenarios that we're talking
Yeah,
about.
okay, but they
Like
can
15
go
jumped out.
down,
Yeah.
they
Yeah.
can cascade to just track and be able to
Yeah.
see what we did
So when we
and
see those-
why we did.
See
Yep.
those numbers and we actually need more funding sooner. Maybe we finance something this year instead of the following year.
Right,
You
and
do.
move
yes.
around.
Okay,
That's why he's saying go down the finance side now, guys.
Mhm.
Financial planning is where you should be.
but we can do that, or we need, you know, to bring in a group of elves to do it.
So, you know, I mentioned to Richard on a separate note, I used to do a lot of this work years ago, but I had a staff and
Yeah, how
resources,
about-
databases and everything else. I'm just a retired guy now with no resources. I'm trying to help you guys develop a framework to think about these problems, these very complex problems about future funding. And I'll try my best to get you as much as I can informationally, but there may be a point where I can help you, continue to evolve and push the framework forward, but I may run into a point where I don't have the data and systems and all that stuff to get us farther on my own, in which case we may need to consider trying to find a consultant that may be able to help in this area.
Financial.
Well,
Or
the tricky thing is,
their own software.
the tricky thing is many of the financial field tends to be very siloed. And you heard it a little bit with Fulton there.
Yeah.
You can go out and find a pension consultant. They're all over the place. Or you can find endowment consultants or healthcare consultants, or they go on and on and on.
Right.
But oftentimes it's hard to find someone who actually looks at an organization holistically. The Lewes Board of Public Works is not just this stuff. It may have a pension plan as well. It may have other types of liabilities. And what I was trying to get at with Fulton, which I knew they wouldn't be able to do it, but I felt I needed to ask the question, is whether they could help us holistically think about, the organization.
Like that.
They may not, that kind of organization may not really exist, but there may be and should be some resources that may be available to help out in this.
We do have UFS that that does our rate structure and everything, that looks at our and our O&M and does predictions of what we need the rates to be.
So one of the things, UFS did it back in 2017, and it's what they call a cost of service study. And what they do is they take a deep dive into everything so that they can match or find where your mismatches are. When Dawn came in the most recent time, she used that 2017 study and did what's called a financial projection based off those numbers. Kim and I have both made the recommendation to the board that even though that was done and it came up with a 5-year projection, that 5-year projection took into account a lot of data from 2017, in which it makes a lot of sense, similar to we had our strategic plan done in 2018, 2019. How much of that strategic plan is actually still viable?
That's your resource, that whoever you said it was, that's your person
UFS.
that you need now.
So we've already made the recommendation, Mike, to the board that has to happen. So what I foresee is as we work through this and we get to a point where that handing off of the baton happens, I think that's where we would make the recommendation to the board, and ultimately the board pulls the trigger on having UFS come in and do that cost of service study, in which we amend. We passed the 5-year rate design. They would come in, do the deep dive into it, and then they're going to make a recommendation coming out of that with full blown.
And you had them in 2017.
2017.
So we've just been giving them updated numbers instead of actually doing a deep dive.
Well, they're your resource.
Yeah.
And one of the things that she actually came out of that, which led into this discussion, was how do you allocate your resources? Because right now, as Kim said, it's one bucket in which we know how it's broken down, but it's all invested the same. So where is your shortfall? Is it in water? Is it in sewer?
Right.
Because that's where your funding sources are. But then you go to the electric side, and really, other than what was passed in the IRA this past month or so.
And that way you can tell whichever one is bringing in your revenue could offset. Right. Okay. Yeah, that's your resource right there.
But right now, in this 10-year projection of capital projects and O&M, there has been an inclusion of the recommended rate increases.
Yep.
Right.
Yeah,
So
that's
so
what I
that's
heard.
something that exists already.
In these existing numbers.
And so Dawn could meaningfully use that what we are developing here, or have developed, the updated August 10-year cash flow. to help figure out the succeeding cascade of iterations
Mhm.
to then, okay, I've got the bottom level of iterations that we could do with our elves, and at that point, Dawn needs to come in.
But she
Or
didn't,
somebody like
she
that.
used to the 217, but didn't you give her updated current numbers?
Yes.
That was just a
But-
basis.
So she used our current budget against the analysis that was
Done
from
in
the
2017.
217. Yeah.
That's
Okay.
how she went after.
So, so she did have some
She did have an
updated,
update, but she
updated,
did not
yeah,
dig deep like she did in 20.
right, no, I understand. Okay.
Yeah.
Yeah, but so got something, we got something out of
Yeah.
it, which was reasonably current. Well,
Well.
relatively current,
Yeah.
let's
Yeah.
just say.
I mean,
Yeah.
it's,
Not
we can,
reasonably,
and we can,
relatively.
just taking the icing on the top,
Mhm.
the biggest, I would say the biggest topic right now, which we just had a call with Dawn about, is power supply cost. In 2017, power supply was night and day different than what it is today.
Mhm.
And there are utilities that are struggling because they didn't have what's called a PCA in place, which takes into account that factor where if you're paying $60, $70 a megawatt hour and you have everything that happened in the last 2 years, influence of COVID, the war in Ukraine,
Mhm.
and that number goes to 150.
Yeah, yeah.
Some
yeah, I
utilities
understand.
don't have the ability to absorb that cost. And so
Mhm.
now you're
Where are you?
stuck. Yeah.
Yeah, okay.
And,
So I understand.
and we're gonna get hit with the Indian River,
Yeah.
Mhm.
boondoggle.
Yeah, the Indian River, have they pushed it off 3 years,
Yeah, it's 5 years till they
5 years?
4 to 5.
Okay,
Realistically.
so that's a real problem. It's gonna be a real problem in the future.
And you're
You have
seeing
to
it,
ask that number.
and you're seeing it across the board. DP&L, Delaware Electric Co-op, they're all doing it. Delaware Electric
Mhm.
Co-op just did, I believe it was 18% on the.
Yes, I
PCA.
know, I saw that. So they're doing it now.
Mhm.
And our
And
PCA will be adjusting as we're getting new charges as well.
So
inflation, labor
Mhm.
rates, you name it,
okay,
it's out there.
so we're gonna get water straight and then we'll go on to something else.
We've already, between Kim and I, Kim
You've been
doing the
working
brunt
on
of
the
it,
others.
Mhm.
we have the others.
We have the other.
Oh, you have?
scenario.
Oh,
Yeah,
good,
they've been
okay,
working
well,
on.
So our
We
next
need to
step
do
here
this
is the
now.
present value, this,
Yes.
Yeah,
This,
do we have
scenario.
the knowledge to do that, or the
It's a
magic
formula. It
Yeah.
is a
Mhm.
formula.
Okay,
Mhm.
It's,
you just press the button.
yeah.
it's not
well,
quite that easy.
Are you talking about present value?
Yes,
Yeah.
yeah.
So the present value, the mathematics of it are quite simple. The problem is the discount rate that you use. That's not so simple. And to do this properly, we typically have a yield curve that's upward sloping or it's not flat, which means that each one of these cash flows year by year should be discounted with a different rate. And where I have to put a little bit more thought into is whether we should be using a municipal bond rate, since you're a nonprofit, or some other variation. Sometimes these things are fairly easy and straightforward in a discount rate, but because I don't have a lot of familiarity with the utility area, I want to think about it. But once we have a discount rate that we're going to use, the actual mathematics of discounting or back to present values are pretty straightforward.
But that's the hard part.
Mhm.
And I don't fully understand or know what UBS would be offering. I think it would be great if they could help out with a lot of this stuff. At the end of the day, and I know Austin and Kim already know this, but you guys are the ones that would be responsible for coming up with the future cash flow needs, regardless of what they're able to bring to bear on that. If you were a pension plan, you would hire an outside actuary who would do all that work for you. But in this world, there isn't somebody, I don't think that you could simply hire that would come in and do all these projections. I think you need to do that yourself, which I know you are. And so this scenario analysis is nothing more than a tool to help, get some insight around or at least try to navigate an uncertain future environment. So I think if we didn't go any farther than this and UBS could take it from here, I think hopefully, I think you'd be well served by going through this process.
Yeah.
But we should be able to take it farther.
So let me summarize. In my mind, what's in our care, custody, and control is the spreadsheet, the scenario analysis procedure, which we've dug into at this point for the net cash flow, 3 lines. And we have it in our ability to do 2 more 3-line summaries based on the one that's shown here. First one is present value, and the second is discounting.
Well,
And
present
at-
value is how we get to discounting is how we get the present value. Yeah.
So it's just one,
It's the same.
it's 2
Yeah.
things. And
Yeah.
The same.
okay, so it's only one set of 3 lines.
Mhm.
And at that point, we need the holistic help or the help from Dawn or to start engaging how to meet what that second line, the second set of numbers shows us. And keep doing the same thing, following the same sequence for the other 3 divisions.
Would it be helpful
Yes,
to tell
no.
Mike
Does that make sense?
what Tomlin does?
Yeah, I mean,
I mean,
what she
just-
did,
He might
she's,
not understand what if they,
She's
she
our
did a
financial
real
projector.
total
Well,
analysis,
she
what they
would
do. Does he understand
She-
that?
they're a rate consultant, but what they
Yeah.
do is they look at every aspect and facet of the Board of Public Works, from assets to liabilities. They take into account the audit. They look at the capital projects and the projections that you have, and that's how they develop the recommendation on what your rates need to be set at, both on a commodity and a fixed rate perspective, and also what you need to do as far as funding sources. So, for example, she could easily come back and say, you need to implement a 20% rate increase, and you need to essentially either bond or loan out 100% of the projects. But then,
Which is pretty much what she said for water.
yeah,
Mhm.
without having that deep
Yeah.
dive. So that's she's essentially an all-inclusive. This is all she does.
Okay,
So, I mean, if I understand it right, like Dawn Lund's outfit, it's somewhat holistic that you're talking about, because they do take our capital budget and use that to, in their case, they're looking at rates only. So they say, okay, they're not looking at our, what our
funding
capital
needs.
reserve has to be. But they look at water and they say, okay, now, if you were to, let's just say, have enough revenue for expenses for the next 5 years, here's the rate you're gonna have to charge in order to get that done. And they look at it over a 5-year period with what our projects are.
But she will also tell you what you need to do on the funding side.
Yeah,
Like, she's not just gonna say you need to implement 20%. She's gonna say you need to implement 20%, and you either need to go to the bond market, you need to push capital
oh, yeah,
projects out.
right, yeah, right, that's true.
Cause she sees that on what's
So she
the
does
ratio.
somewhat
I'm drawing a
holistically.
blank.
So Tom,
What's the
that's
ratio?
kind of what I would call the financial planning component, which, is
Absolutely.
that's, now you have a hole, what do you do about it?
I
Right,
understand, now I understand,
right.
yeah, okay.
That's the value
Mhm.
of that person.
You
Yeah.
know it.
You've taken yourself right up to
Mhm.
financial planning now.
Right,
Yeah.
okay,
So here we're just
Okay.
trying to understand what's the nature of financial planning? What do we need? If these numbers were all 0, let's say, we didn't have any, everything matched up real nice and there was no difference between the best and worst scenario, life would be easy. There's no planning necessary.
Right.
That's not
That's
the
why
way.
they got.
It wouldn't be as much fun.
Right. Okay.
But we should continue doing the other 3 divisions, because there may be something that jumps out as a result of the other 3 divisions
It'll show you where your
set
money is.
together.
That's what's gonna jump out.
Mhm.
And
It's gonna show you where your
especially
money is.
separating them out into the divisions
And how you can
helps
work
us
with
get them
insurance.
each to be self-sufficient and as a standalone potential.
Debt coverage ratio.
Are these legally distinct organizations? Or in other words, let's say that the other
No, we're
ones
all
had positive net cash flows when the water had negative net cash flows. Could those cash be used to
That's,
cross?
yes,
Yes.
this is all one under their umbrella. They can offset.
But our
one.
goal is for each one to be healthy, not one. being
Self-sufficient.
Exactly,
bad.
but it'll show them where their money is.
Yes.
No,
But
it's
electric-
all-
You could come out with a situation that over the 10-year period, all three of these are self-sufficient, but that in any given year, some are negative, some are positive. And, that could be a powerful thing. In finance, we call that diversification of cash flow.
It'll show you-
Yeah.
Yeah, definitely.
And so that'll be another interesting thing to understand when you guys get these other done and we look at it on a year by year basis. This
Also be
timing of cash flows may actually be net helpful. The negative will be if they all go negative at the same time and they all go positive at the same time, then you don't really have that effect.
Mhm.
So
I
the
like
hardest one that I had doing a scenario for is sewer, because we are so up in the air with our long-term study of what's gonna
Wastewater
happen
treatment
to our
plant.
wastewater treatment plant,
Yeah,
who's gonna be in charge of it, if it's even gonna be
Right.
in commission.
right.
So
And how much
That
it's gonna be
is-
taken over by.
those numbers are all over the place. And even the weighted average, I don't even know if it should be 35-30 or if it's just 25% for all of them, because who knows?
Yeah, what we did
There's
is
too
on,
many unknowns there.
Yeah.
on the plant, we only did 5. I only did 5 years because I cannot do
Yeah,
an
really.
additional
Why
5. It's
would
gonna,
you?
there
You don't
is.
even know where it's gonna be.
Does,
Yeah.
does not compute.
Right.
But, and this goes back into one of the comments that Mike had made, is that in the reserve policy, there's a section, and we just got done talking about insurance internally. We had Mike Sutherland in, and one of the things is you self-insure $2 million, and that's within the reserve policy, and that's for pollution and flood.
Mhm.
Well, we got back a quote for pollution, and for 3 years, it's $15,000. That's your premium.
Yeah.
And it covers all facets of the utility, and yet you're self-funding it for $1 million.
Yeah, no.
Prime example.
I'd like
You
to see
know, yeah.
these insurance, because you're right,
Pollution's a different story. I mean, flood's a different story, but
when you have uncertainty and you can insure it, you
Yeah.
should.
It's just how much you insure it,
yeah.
So,
reality wise.
Would we be well served, we're going off a little bit, of establishing our own resiliency fund or line allocation, like a contingency fund for emergencies?
I think that's your reserve policy.
Yeah.
That's exactly what reserve
But-
is for.
But it's not. But we're using some of that reserve policy to fund the regular operations. And if we want a separate, I don't know, increasing resiliency fund, emergency fund, contingency, that you want that one to kind of grow and stay separate from being grabbed by the reserve policy.
but
Money.
you can do it funded wise, but you also can do it through, like we have a letter of credit. As you can use a letter of credit as an emergency fund and use the other analysis for your ongoing operation needs.
Okay,
It's like insurance, and risk management is what it really is. You look at the risk and you say, how do we want to manage it? Do we want to put it out of our own pocket, or do we want to spend $15,000?
Now or later.
okay.
Um,
So is the insurance, an emergency occurs,
Mhm.
and how fast is that insurance money available?
Right away.
Same as cash.
It is.
It's
Okay.
in
Yeah.
your security blanket.
I think it'll be overnight.
Yeah,
Keep
no,
an
that's
umbrella
what it is. It's a,
Okay.
you can treat it as a line of credit.
Yeah.
Yeah,
That's what
your
insurance
fee
is.
is $15,000 and now you got whatever it is, million or 2 million or whatever. Now you have a 2 million line of credit for pollution.
It's that way of,
That's fine.
it's the,
I like that.
it's the
better.
old way of thinking versus the new way of thinking.
Mhm.
And that is the way of getting flexible and making sure from a financial standpoint, what makes sense, what doesn't make sense versus what was done in the past, saying, I'm just gonna self-insure it. And if it happens, I got $1 million there that I self-insured. Versus taking the $1 million that you're holding for that and saying, if it costs me $15,000 for 3 years or $5,000 a year, that frees up
Yes.
$995,000.
Yeah, the risk management
Perfect
part
way
is
of
to
saying
say,
it.
I've got that $1 million, but if I'm gonna use it for self-insurance. Oh, that's great, because if I invest it, then it'll be
That
in
15
10
million,
years,
that
it'll be $1 million too.
15,000 is working.
But so
for
what?
you, As opposed to the cash that is
Yeah,
sitting there.
exactly.
Just
So
risk
you're just putting the risk and the management together
Yeah.
and say, okay, this is what I'm gonna do.
And what we're doing is really the hard part, is having the discussion, because nobody wants to see the red,
Right.
right?
And the
But
reality
that
is
is
always a
real.
problem.
Yes. And so that reality is going to set in, and then you have to make a decision as
Yeah.
the
What do
board
we do
and as
about
of
the
this
reality?
committee.
And without doing this, we drift from year to year and, fluctuating reserve policy or, a fire drill of, where can we get the money here?
And then from an
Okay.
insurance standpoint, the other mitigation way to do it is deductibles.
Mhm.
So what you say is, I'm willing to risk. I'm not willing to risk $2 million, but instead of paying $15,000, I'm willing to risk 50 as a deductible to get it down to $12,000 or whatever.
Right.
10. And so that's the whole scenario you look at.
Else, I think we
Well,
know. where we-
Okay, well, we've got a lot of stuff to do here,
I-
Mike.
I think we should target another meeting in another 4 weeks or so. And we'll just see how it goes and continue to progress and share information.
Well done, Mike. I love having your experience,
Yeah.
man.
Definitely, Mike.
Thank you, Mike.
What you've done is really given us a lot of real help. And I want to thank you for it. And, but we're just going to have to really do a lot more work.
Yeah.
Which is fine.
It is a lot of work, but as everybody in this group, I can hear just by the interplay understands that the financial aspects of these problems are very important. A lot of times you think about the engineering side of it, but every operating company has a financial side of it too. That's why companies have COOs and CFOs. Kind of work through these. So that's you all have your CFO hat on right now.
Okay.
You just
Good. All right.
Alrighty.
Thank you.
See ya.
Aaron,
Thank you.
Take care.
Aaron, are you on? Are you muted? You're muted. Okay.
Sorry, yes, I'm on. I do not have any questions. Thank you very much.
Okay, you're welcome.
Thanks for attending again.
Yes, thank you.
Yes, you're welcome. I appreciate you having me.
Have a great day.
Thank you, you too.
You need to set a date.
We're gonna do an APB,
Oh, just
yeah,
email wise?
yeah,
Okay.
like we
Oh,
did
do
before.
email wise.
Oh, okay.
So, 'cause
Okay.
at the end of this
Harold,
month,
you.
Gesundheit. At the end of this month, the beginning of October, there's a lot of meetings
You got that right.
going on that we don't wanna add another one to the 8th.
What?
Is the meeting over?
Meeting is
Motion.
over.
Thank you.
Motion.
I got the next.
Okay.
Thank
we-
you. I need a motion.
Unless you
Have
have
a
a
motion?
I make a motion that we adjourn.
Second,
Second.
second.
all in favor?
Aye,
Aye.
thank you.
So you don't have an opinion?